Hereby I open this academic ceremony in which Flavio De Carolis will defend the academic thesis, Let's Get Physical, How Floods and Storms Affect Asset Prices and Capital Structures. May I invite you to present a summary of your study and the conclusions of your thesis.
Dear Pro-Rector, dear members of the committee, dear colleagues, family, and friends. I'm truly honored to have the opportunity to share the findings of my work with you today. And I want to thank you all for being here. In my research, I investigate the impact of extreme weather events on asset prices and capital structures. Sono davvero onorato di avere oggi l'opportunità di condividere con voi i risultati del mio lavoro e desidero ringraziarvi tutti per essere qui. Nel mio studio analizzo l'impatto degli eventi meteorologici estremi sui prezzi degli asset e le strutture di capitale. Ik ben er werkelijk door vereerd dat ik vandaag de gelegenheid heb om de bevindingen van mijn werk met u te delen. En ik wil u allemaal bedanken voor jouw aanwezigheid. In mijn onderzoek bestudeer ik de impact van extreme weersomstandigheden op activaprijzen en kapitaalstructuren. We often think of extreme weather events as something that impacts emerging markets. Nevertheless, the pictures that you see behind me are all from Europe. Those are the impacts of extreme weather events in Spain, Ireland, and Germany. In 2024, massive rain caused severe floods, which brought to the loss of around 200 lives. Storm Char in 2020 battered Northern Europe and caused around 1 billion damages. And there is another event that I still remember because it marked the beginning of my PhD, the summer floods of July 2021. Actually, I remember very well because that day I had lunch with Rob. We were sitting down the road and talking about what I will do in the next 4 years of my PhD. I then take my car, drove through Liège, went to France, and I could see from the highway that the water was already at the highway level. A few hours later, the same river caused massive floods and damages. Now, that these events cause damages, it's almost obvious to everybody by seeing the pictures. But the question is, how do they impact financial markets? There are 3 channels that one can investigate. The first one is the supply channel. It's the one that one can think about the local car manufacturer that has to hold production. The machinery is damaged and cannot produce anymore. Close interconnected to this, there is the financial channel. This means when the local car manufacturer cannot produce anymore and did not insure some of the machinery, then we'll have to ask for credits to finance again for the physical assets. And for this, we'll ask then help to the local bank. And finally, we have the demand channel. This means basically the consumers that will have to face maybe higher prices from the local car manufacturer and will decide to opt for competition, or maybe even delay purchases, forcing the local car manufacturer to have some issues with profits. These 3 channels are highly interconnected, and in the work of my thesis, I investigate them separately with the supply channel and the financial channel together, and the demand channel and the financial channel. In the second chapter of my thesis, I investigate in the specific the behavior of investors in Europe that are used in Europe to invest in segmented markets. Here we have the example of Hugo, who likes to invest in Renault because he knows the company best, knows where the production facilities are, and therefore prefers to invest in that company. However, we have also another example, Anna, who is in Germany, and of course, knows Porsche and the production facility of Porsche best, and invests in that company, but also thinks, okay, why not? I need to diversify my portfolio, one of the basic concepts in finance, and decide to invest also in Renault. However, the knowledge of Anna towards the production facility of Renault is slightly lower. Now, in my work, I identify production facilities and I link them with their parent company using a fuzzy string matching, connecting two types of data sets, the one of production facility from the European Commission and the other one on parent companies. The results of this study are interesting for several reasons. The first one, as I do find interesting results for storms, but not for floods. Storms have a negative impact on returns compared to floods, for which I do not find significant results. Additionally, local ownership mitigates the negative impact of the storms. This means if Hugo, or there are more Hugos investing in Renault, then the negative impact on asset prices will be lower. I test this information hypothesis through two channels. The first one is the distance of the production facilities from the headquarters of the company, as we see here from the picture and the arrows between Anna and the production facilities that are impacted by events. And the second one is through the knowledge of the investors towards the exposure and vulnerability of the production facility. To this extent, I used a methodology developed by the Eurosystem, the expected annual losses, computed at a production facility level. Now, investors that know more about the production facility they invest less if they know that this is resilient to the impact of extreme weather events. Results are robust also to these two additional channels. I then move from the different perspective, the one of investors in Europe investing in the US. To this extent, I'm lucky that I can use data sourced from the Italian and the Dutch central bank and analyze which type of investors and the two different geographies, Italy and the Netherlands, and how they react to extreme weather events in the US. Several interesting findings occur here. The first one is when investigating by investors type, I do see that longer-term investors, like pension funds for instance, reduce hurricane-exposed equities and increase bond holdings, showing that they opt for a type of asset that is more resilient, that at least brings more safety, as from bonds at least one can recover collateral. The second result is that Dutch investment funds, which are shorter-term investors, sell affected equities less than unaffected ones. This shows, in my view, but of course findings are not finalized, this shows that shorter-term investors are seeking for financial returns, as see more returns from impacted companies. An additional finding from this chapter is that results vary across geographies. Italian institutional investors tend to exhibit more muted reaction with respect to Dutch investors. Then I move from the demand channel and the change in behavior from the investor's perspective to the supply channel, as I was mentioning before, the local car manufacturer. And to analyze this type of channel, I focus more on the type of companies that are more vulnerable and exposed to the impact of extreme weather events. Small and medium enterprises. Small and medium enterprises have concentrated assets and are thus very vulnerable and exposed to the impact of floods. On the same time, small and medium enterprises are very important in Europe. They are around 99% of the enterprises in Europe and also employ around 2/3 of the workforce. In the fourth chapter, I look at the effects of leverage and debt maturity and the resilience of flood impact in small and medium enterprises. To analyze what is the resilience of these companies, I use a large data set of several million observations over 9 European countries from 2012 and 2020. I take the addresses of all these companies, I locate them everywhere in Europe, I take the latitude and longitude, then I take flood maps, overlap them, and using this type of methodology, I'm able to discover which companies are impacted by floods. Then with an event study, I can analyze the impacts on the resilience of these companies. This analysis has several findings which are relevant for investors and researchers and regulators. The first one is that moderate leverage supports resilience, but high leverage, and this kind of seems obvious, undermines it. Of course, if I'm highly indebted, I will not be able to take more credit. But the fact that I have some space gives me the opportunity to be more resilient to the impact of extreme weather events. The second and more relevant finding is also that debt maturity is very relevant. So if I have a high level of short-term leverage, this will amplify the impact of flood-related damages. When I think about it, I try to make more sense with an example of a sovereign, for instance. There are sovereigns that are very exposed to extreme weather events, like, for instance, Jamaica. It's a small country, non-diversified economy, and if it's impacted by a hurricane, will have strong difficulties to pay back the debts. So this is similar also for small and medium enterprises and might also relate with this case. Another finding is that limited long-term debt also reduces resilience, because it can be an indicator that the company is not able to increase the amount of credit. Connecting the findings together over the 3 chapters, so the demand channel and the supply channel connected with the financial channel, I have 3 main findings. The first one is that local institutional investors mitigate the negative effects of natural disasters on asset prices due to the information advantage of proximity. The second one is that foreign investors disengage from impacted securities, but level and depth of disengagement depend on the investment types and regulatory frameworks. The third one, from the supply side, is that firms' financial structure condition their resilience to floods. With these findings, I developed some advice for regulators, investors, and researchers. The first one is that to enhance financial stability, we need better data, more disclosure, and that all types of investors have access to local information. Having better information leads to the second advice, that will lead to a more efficient global allocation. As I was mentioning before, segmented markets make idiosyncratic shocks systemic. And if we had the possibility to diversify, and we had not the issue of segmented markets, then we would not have the same issue that there is an impact on portfolios, investors' portfolios. And the third one is that we need to strengthen the resilience of small and medium enterprise to extreme weather events through targeted capital policies. I thank you for your attention, and I now give the floor back to the prorector.
Thank you, Flavio, for your nice presentation. The opposition will be opened by Peter Schotman, who is Professor of Empirical Finance here at Maastricht University, and he's also chair of the Assessment Committee.
Thank you, Mr. Chairman. Dear candidate, dear Flavio, let me first congratulate you with a thesis containing an incredible amount of empirical data. And I think just linking some of these databases, almost a thesis in itself. but for you that's only the start of the analysis. And also my appreciation for your responsiveness to comments. And in my comments on your first draft, I mentioned some topics that would be nice to discuss here at this event. And then when I opened the final thesis, I saw that you already addressed some of these issues. So for that reason, I'll go to another question, and I would like to discuss some issues about the empirical methodology in chapter 3. And the problem in chapter 3 is that you only have a short time window of 4 years over which you observe changes or where you analyze changes in holdings of individual stocks by pension funds and other investors, both in the Netherlands and Italy. And your main hypothesis, hypothesis 2, is that these pension funds reduce their holdings of stocks that experience climate risk or are exposed to these extreme weather events because they cannot really properly measure the risks, and that's why they will have some home bias. But instead of, so now I come to the question and to a suggestion of another way to analyze these data. So instead of looking at these traits and all these changes in holdings that may be very noisy over these 4 years, and why didn't you analyze the average holdings in that period and relate them to the extreme weather events that were there in the past 5 or 10 years, and then test whether these holdings differ from what you would get from, for instance, a valuated index, because then you could basically test whether these pension funds that, because you already 5 to 10 years after the Paris agreements, so they know about all these climate risks already for some time. Just then you could focus on the levels that are probably less noisy, and you could test whether these levels differ from an index, and you could relate that whether the differences from an index, from a valuated index, are related to the amount of exposure of all these firms and how they are exposed to climate risk. What would be your opinion about such an empirical methodology?
Highly esteemed opponent, thank you for the kind words and also for the very interesting question. I have to say that you point some weaknesses in the work, if you want to say like that, because of course the chapter is still has a lot of room for improvement. I did develop this analysis in the last 4 years due to regulatory disclosure requirements. It was mandatory to disclose the amount of the changes in all holdings by the institutional investors as of 2021. So that's one reason why I actually make the time window that I analyze from 2021 to 2024. So that's one reason why I focus only on this short time frame. It's for regulatory reason, as institutional investors in the beginning had a freedom to report on their holdings. So it was voluntary and not mandatory. As of 2021, they have to mandatory report on all their holdings by ISIN level, something that was also aggregated before. So that's only to answer the question on the time window.
Maybe then let me clarify. So I'm fully aware of the limitations of your holdings data, but my question was, suppose you have your holdings data in 1 year, let's say 2021, but you have these extreme weather exposures. You can probably know it because you know all these weather events for at least 10 years back. So you could basically single out all the firms that were very much exposed to climate risk and see whether firms that were the most exposed to climate risk have lower holdings in 2021, because these pension funds probably knew about all these climate risks for quite some time.
Okay, so let me rephrase your question so if, to make sure that I understood it correctly. So you would say that I had to focus more on the holdings in companies that have been historically impacted by extreme weather events and see whether pension funds decrease holdings already in the years that I want to analyze.
Or just had lower holdings compared to evaluated index of US stocks.
Yeah, I do think that it's definitely an interesting methodology and that the paper would profit a lot from such an additional analysis. I do see that could be a way to enhance the current work.
Okay, thank you.
Your position will be continued by Alexander Andonov, who is Professor of Finance at University of Amsterdam, and he's also a member of the Assessment Committee. Floor is yours.
Dear Flavio, I would like to congratulate you also on writing a very comprehensive dissertation that includes a lot of data sets, as was mentioned, and also a lot of econometric techniques. You study supply and demand of assets and some pricing implications, as well as implications for portfolio allocation, which gets kind of close to my interests. So my question will be also on chapter 3. In this chapter, and Dutch pension funds, I have thought also a lot about them. So what you find is that Dutch pension funds kind of, when there is a hurricane event, they reduce their holdings of hurricane-exposed equities and reallocate assets to unaffected bonds. And you interpret this as reassessment of fundamentals rather than rebalancing. But I'm curious about a couple of things. First, how is this executed in practice? Because this is very different teams. There is a team that invests in equity, team that invests in bonds. An equity manager cannot just go around and say, I don't like these equities anymore, I'm going to buy some bonds. Then, what does it imply overall for kind of the risk exposure? Because moving from equities to bonds, maybe kind of you're removing the climate risk, but you're kind of removing also other risks that you would like to take as an investor, like exposure to the equity market premium. And third, maybe what intrigued me most is like, is it possible that these are just rebalancing flow due to aggregate market movements? Because in your sample period, equities were doing very well. You do look at rebalancing within one stock, let's call ABC, but not on rebalancing flows on an asset class level, like how equities are doing relative to bonds.
Highly esteemed opponent, thank you for your question. I tried to answer all the components of the question. The first is the one concerning the practical execution. Here I'm not claiming in the specific that there is an overarching strategy. It's more that there is a behavior that could be implemented well by different teams in a specific pension fund. However, they do all have to report to a single manager. So I do think that there could be in the specific the possibility that there is an idea to move away from some type of risk and be at least certain to recover some type of returns, especially if some companies are very exposed to extreme weather events. So that's the first part, and I hope this answers partly your question. The second one is implication overall whether pension funds want to take this risk.
Or to remove the exposure to equity market premium.
How?
Because they reduce exposure to equities, that they kind of are less exposed to the equity market risk.
So you mean that they would be less exposed to equity market risk to have less volatility in the portfolio?
Yeah, that the entire portfolio is exposed to somewhat different risks.
Yes. And the reason why they would do so, it would be completely unrelated to extreme weather events, in your view, if I interpret correctly, but rather more due to wider market changes that are within the time frame that I analyzed. For instance, COVID.
Yeah, when equities were doing pretty well, and some magnificent 7 companies.
Yes, I do understand the question. I made some extra analysis in that regard, because of course I was also myself worried about the occurrence of COVID during that analysis. However, actually in the years where there were more market movements, this was less the case. So that's maybe answer your question in this specific regard. And then that is just possible to normal rebalancing and at an asset level. I do believe we argue actively against normal rebalancing, but more active strategies. And this depends also from the investor type as we elaborate in the chapter. And the significance and the usage of specific fixed effects should also account for these type of analysis. And also, if I do think about rebalancing instead of active trading, I think the reason why I argue against this is because we are able to assess the extent of trades coming after the extreme weather events. Yeah.
Oh, sounds good. I think your time fixed effects might be a step in the right direction.
Yes, that's. I hope I was able to answer the question this way. Yes.
Thank you.
Thank you.
Your position will be continued by Marie Lambert, who is a professor of finance at HEC Liège, and she's also a member of the assessment committee. The floor is yours.
Dear Flavio, thanks a lot for this thesis. I really enjoy reading it. Congratulations, because it makes a clear contribution on the literature to sustainable finance. First, it addresses a very key question on how we inform our investors about climate risk, how they react to it. Also, it confirms the financial materiality of climate risk for investors. And finally, you rely on very unique data set to provide a direct identification of all these questions. So congratulations for this piece of work. I have a first question on chapter 2, which is a very it's a super piece of work. I think you did a very great job at explaining the economic channel with regard to information asymmetry. So I would like to challenge you a little bit on this economic channel. And is there any other channel that would be consistent with your results that you did not investigate?
Highly esteemed opponent, thank you for the kind words. Yes, indeed, chapter 2 was a lot of work, also on the data component. Yes, I would say the two channels investigated in this specific chapter are aiming at supporting the information hypothesis. Of course, if one wants to be 100% sure that it's only the information hypothesis, should continue to testing all possible other channels that there are there. And completely agree. This maybe goes slightly further than the scope of our PhD thesis, but definitely for an academic publication, I do see this work as necessary. There are other channels that could explain it and are also introduced in the thesis. One, for instance, could be commitment of the investors, or also so kind of behavioral biases in the specific. In this work, I argue against behavioral biases and try using the methodology on the knowledge of the specific exposure of facilities or the distance from the information source to support the information hypothesis. However, I do not investigate all other possible channels that could explain that. I do find that for this specific chapter, there is enough evidence to support this part of hypothesis, but there could be other potential ways to exclude other channels that might undermine the information hypothesis, like, for instance, commitment to investment in the local market.
So, yeah, you mean loyalty of the...
Loyalty of the investors, for instance, yes.
I have another question on your chapter 4. So if the way I understand it is that you want to measure the financial slack of the company in a way. You want to say that the companies that have still room to borrow money can maybe resist more. Is it the thesis for the chapter 4?
Partly.
Partly?
Partly, yes.
Because the way I see your results, it's more about debt capacity, that the company is able to recover from the big losses by being able to refinance the operation. So I was wondering whether the measurement of this financial slack and debt capacity is appropriate with regard to just the position of debt on the balance sheet, because there are so many things that could influence the debt position of a company. We know that companies that have more innovative assets borrow less money, etc. So you can have also bias with regard to the management team with regard to debt. So I was wondering whether it's a good measure, and what do you want to prove at the end of the day in this channel?
Okay, thank you for the question. So for the debt position, of course, here we are talking about small and medium enterprises. In general, this is companies that might have some debt capacities, but are more constrained compared to marketable assets. Also in the access to credit. So a further analysis that could be interesting in this chapter would look at the relationship lending between small and medium enterprises and banks, something that goes outside the scope of this chapter in the specific. However, why it's relevant to analyze this is to show that it's important to foster resilience from a corporate perspective, to be able to have some leeway to weather extreme weather events as they are highly damaging for the machinery or physical assets. And if these assets are not insured, companies do need, differently than from other type of shocks, do need access to credit to be able to refinance growth again. So showing that is relevant because this is a shock that is different from other type of shocks that are present. And concerning the question on what we want to show is that we add on the literature for resilience to show what is important from a company perspective to be resilient to the impact of extreme weather events. Something that needs to be investigated further to act in to be strategic from a corporate perspective.
From your answer, I understand that we speak about the same thing. So it's really about the financial slack of the company and the capacity of refinancing. So maybe you could have a look at this specific literature. And also, I would also advise you maybe to go more into an alternative measure of the debt capacity of the firm with all the ratio that relies more on the capacity of the firm to generate cash flow and to borrow money than just measuring it with the current position, but I'm fine.
Thank you.
Your position will be continued by Mark Sanders, who is Professor of Finance at Maastricht University, it says here. So that's not true, I think. No.
Definitely not finance.
Definitely not finance. It's
International economics.
exactly. It was yours, Enya.
Thank you. And let me first echo the congratulations on a job well done. And it's really nice to also see an exchange on a paper that I know very well with some interesting suggestions how to proceed with that one. But that's not what my question is about. It will not surprise you maybe that my questions refer to chapter 3 and follow up a little bit on what Peter has started. So you have the research question there, and I will, it's only fair to assess papers on their ability to address the research question that is posed. To what extent do information frictions shape the responses of European institutional investors to US hurricanes, and how do these responses differ across investor types, investment horizons, and asset classes? Now, I have a lot of text here. I will skip it all and go right to the meat of the question. I was wondering, and I'm not an econometrician, so I'm hoping to learn something here. You split your sample. You split the sample on asset types. You split the sample between Italy and the Netherlands. I see where that is coming from, but also on asset types and also on these investor types, and then compare the coefficients that you estimated in these split sample regressions. And I was wondering, should you not rather, if you're interested in these differences, set it up in such a way that you actually estimate in one estimation, in one run, the differences between these dimensions. So using interactions or latent class or whatever else technique you could have up your sleeve. I'm very curious to hear your answer.
Highly esteemed opponent. Thank you for your kind words and also for the challenging question. I do know that and realize also now that chapter 3 raises a lot of interest, and I do think there is a lot of room for improvement in that chapter. But to address your question, why would you split the sample? I would start by one part of the answer is that unfortunately in the Eurosystem we are not able to communicate some data sets, something that is work ongoing. And that's why first there is the country splits, and this is as it is. There is nothing I can do about it. I just try as much as possible to.
Yeah, that's the easy answer.
That's the easy answer. Yes, I completely agree. The other one is on the difference between bonds and equities. To answer this type of question, I refer in the specific in the literature. However, working on this chapter, I also did realize that there is a lot of scope to analyze also, for instance, on a holder level, how they switch between specific companies. If they are holding bonds and equities from the same company that is issuing both bonds and equities, how they would behave on the same company. It's something that I did not investigate in this chapter, but it would definitely help in the future. I will be honest about the fact that was not implemented in this analysis here. I do include interaction terms concerning the institutional ownership and the interaction with events. However, yes, I do not do that for equities and bonds together in the specific, something that could be addressed in the future, in future work.
Yeah, and also the investor types.
Yeah.
That analysis is later in the chapter, but that's also with the split sample, right?
Yes, so the split over investor types. So the first image, I try to address this question then going back on the results. So the first image is looking at, picture is looking at all investors together. And there we do find that results are kind of mixed, because we have different type of investors in the same crowd. Mm-hmm. Now, splitting the sample helps us to disentangle which investor has which type of behavior in the specific. I did not do that with interaction terms in this analysis. As I followed the literature in the specific, so
okay.
But it's something that could be implemented.
If I can follow up a bit, because I had another question, and you should never skip an opportunity to quote the famous Louis van Gaal.
Yes.
So in chapter 3, you collected the data on Italy and the Netherlands. It's of course interesting also because you are doing your PhD in the Netherlands and are originally from Italy. And in the descriptive table, to me at least, it was striking because the type of equities and bonds, I assume, these big institutional investors will be buying and selling traded assets, traded equities, traded bonds from relatively large firms in the United States, multi-establishment, that's another issue. But then in your descriptives, I see that the Italian investors realize an average stock excess return of minus 0.5 and a bond excess return of minus 0.2. And in the Netherlands, we realize plus 0.6 and plus 0.25. So I was wondering, what are the Italians doing wrong here?
I don't know. I'm not the institutional investor from Italy. No, but now seriously, I do understand the question. I understand that there are differences that most likely you are pointing are rather big between the financial results of Italian investors and Dutch investors. However, one has to say that in the sample from the Italian investors, pension funds are missing, as they are aggregated at only in one. We don't have disentangled data for Italian pension funds. So this part of comparison is not available there. And then part of the difference of the results might be that a consistent amount of investments is not included in the Italian descriptive statistics. So it could be that maybe the best returns are coming from pension funds, and that's for doing slightly worse.
Well, then I'm going to very briefly come back to my prior question, because this really shows that the samples you're comparing in your split sample analysis are very different.
Yep.
And that would probably imply something for this, how shall we say that, the soundness of how bold you state your conclusions. Let me phrase it that way. And then I'll give the floor back to the...
Thank you. The opposition will be continued by Niels Kok, who is Professor of Real Estate Finance here at Maastricht University.
International economics. Okay. Dear candidate, dear Flavio, thanks for the opportunity to review your PhD thesis. In the same way that most people start reading The Economist by looking at the obituary, a dissertation review needs to start with the acknowledgements. And Flavio, what greater compliment could I get by being identified as part of the real estate mafia from an Italian, no less. So that was the beginning of the joy. And I have to say that even though this is not officially a real estate dissertation, your work with lots of GIS makes me very proud. And I have to admit that I'm somewhat infatuated by your papers, their extreme level of detail on data collection, and the extensive use of a variety of data sets. It's not just impressive, but interesting and important work. So let's start with congratulations. Now, the downside of my infatuation for you is that I kept on scribbling questions and notes in your book. So we'll talk about a lot of that after. I have questions both at the macro and micro level, but we only have a couple of minutes and the clock is ticking, which you like, but we don't. So chapter 2. You investigate the impact of two types of weather shocks on equity price of European firms against smart matching between facility-level data and company names and subsequent data sets. Your interest is mainly in the moderating effect or the interaction between local economic ownership. We just talked about it. And you add a very granular measure of climate risk as a further interaction factor. And you spend a lot of time on that EAL. Now you need, as always, to make some shortcuts to make the data work. For example, on the definition of a local shareholder, where you need the company HQ and the investor HQ to be in the same jurisdiction. And that's a big assumption. So as an illustration, let me briefly warm you up here. I'm going to give you 4 companies and tell me for each whether they're Dutch or not. So it's going to be fast. DSM.
I'm not sure I know DSM.
Half right. It's Dutch-Swiss.
Yeah.
Unilever.
I think it's not Dutch anymore.
That's right. It's listed in the UK, but we consider it Dutch.
Okay.
Shell.
It's also not Dutch anymore.
Very good.
Consider Dutch, yes.
Magnum.
I don't know Magnum.
It's Dutch. Yeah. Well, at least it's listed in the Netherlands. So.
Magnum. Okay.
Yeah. Magnum, the ice creams, right?
Oh.
So this shows the difficulty in making these assumptions.
Yes.
Now, other than that, your data work is nothing short of impressive. But I have to say that I find your subsequent empirical analysis a little naive, if I may. Today I still may, until the moment that you hopefully get your doctorate. So you regress these daily cars on LOI, I call it, but local economic ownership, and EAL, expected annual loss, using a fixed effect regression according to table 2.7. I won't bother your paronyms with it, but it's there. So I kept on looking for the fixed effects, but Flavio, to no avail. And the analysis basically screams at me, omitted variable bias. And I personally see a couple of venues for enriching the analysis to reassure the reader that we're not interpreting the results on, for example, LOI relative to CAR and EAL as an interaction factor for something else that's out there. So my question for you is, in an ideal scenario, before submitting this paper to the JF, how would you adapt the analysis to alleviate my concerns?
Highly esteemed opponent, thank you first for your kind words, and also for spending time to analyze the work in depth. Highly appreciated. For the omitted variable bias concerns that you might have, the reason why we do an event study analysis on a daily level in the specific, it's actually to avoid this type of issues. So to be as close as possible to a causal interpretation. Of course, we do not have highly frequency data, we have just daily data. We account for also different type of factors, we use different type of methods to analyze the event study. So I do think in the specific that I would not have as much an omitted variable bias in the analysis. However, I do acknowledge that the definition of local ownership could be improved. So something that I would do in a more developed version of the paper is to enhance the definition of local ownership and see whether results are consistent over different type of definitions.
Great. Well, I'm not letting you go that easily, Flavio. So let's talk about the intensity of the events. And think about how that intensity might be correlated, for example, with your measure of EAL, and how you could include the intensity of an event as a factor in your analysis.
Yes, I could include the intensity of the event as a factor in the analysis. In fact, it's definitely one of the extension thought for this paper. So as we are able to compute the expected annual loss at a facility level, we can also compute the expected loss from an event type. So that's something that could be included for storm and definitely also included for floods. However, in this case, we see that there is no market reaction for floods, so I would do that for storms. And for storms, it's easier to be implemented.
Okay, and maybe one more quick follow-up. So I looked for these fixed effects and I found time fixed effects. If you were to have the opportunity to include other fixed effects in your analysis, what would they be?
In this specific, I would not include other fixed effects, as the relevant one is the one of the time in the specific when the event occurs. So I would...
No company fixed effect?
For the sample size available here, I do not deem as relevant, but if we had a broader sample size, we could include it, but we also leave some heterogeneity out of the regression. So,
okay, thank you.
The opposition will be continued by Esther Eiling, who is Associate Professor of Finance at the University of Amsterdam. The floor is yours.
Dear candidates, dear Flavio, let me first congratulate you on your thesis. It was a pleasure to read. I think there's no doubt that analyzing the negative realizations of climate change on financial markets and firm performance is a very relevant topic for policymakers, academia, for society at large. So congratulations on that. My question is on chapter 2. And in this chapter, a central assumption that you make is that the markets are segmented. And so you sort of build upon this well-known Merton 1987 model or framework where investors can only invest in the stocks that they are familiar with. And I think in your setting that would translate into them only investing in local stocks. But your sample includes mostly developed European countries. And sort of what we know from the international finance literature is that those markets tend to be quite well or perhaps even fully integrated. And so what would create some of these barriers? Well, you write regulatory barriers, transaction costs, information asymmetry, geographic limitations. Still, in the context of your sample, I was wondering if you can elaborate a bit on how realistic those barriers are. And sort of related to that, the way we think about market integration or segmentation from an asset pricing perspective, well, we would say, well, fully integrated markets, you know, the expected returns are driven only by global factors to which these markets are perhaps differentially exposed. And if the markets are segmented, then these local factors would be the ones that drive expected returns. So here you would look at climate risk or risk related to climate change. So then my question is, how would you view this in the asset pricing setting? You kind of refer to it as an idiosyncratic risk. Could we instead think about it as a systematic priced risk? And would it be of a global nature to which stocks in different countries have different exposures? Because if so, that would fit in a framework of integrated markets. Or should we think about it really as local sources of priced risk in sort of your segmented markets model? Thank you.
Highly esteemed opponent, thank you for your kind words, also for the very challenging question. Part of the work you have been mentioning is something that is going to be definitely part of my future work. Now, let me first address the reason why I do to think that Europe is still a segmented market. First, we were not able until now to create a complete union in this perspective. There are several types of barriers for investors across Europe that are of regulatory nature, as we know that legal environments might be similar or regulated similarly, but they are also very different across Europe. Then there are also language barriers within the European countries, so between European countries.
Can I ask though, because in the context of sort of, asset pricing and financial markets, the type of barriers we think about when we think about these models of integration or segmentation are really barriers to investors holding assets in the other countries. And I would think that, for investors generally, they could invest quite easily in stocks across Europe.
Yes, I do agree with you that they could. So let me rephrase the market segmentation as is interpreted in that chapter, in the specific. So there are two types of segmentation we can think about. First one is that the investor, several, but two I think about in the specific in this chapter. The first one is that investors might not know some assets, so there is market segmentation, the one I think you are trying to address. The other one is met on the depth of knowledge on specific assets, how much I know on the specific asset. And I think this is more the kind of segmentation that I try to address in this specific chapter. So it's not about the existence of assets, but the knowledge depth. So how much I can know about a specific country. And this is particularly relevant for extreme weather events because this is kind of a risk that has been developing more and more in the market, and the disclosure has been demanded by investors in the last years. So the level of depth of it's segmented across between European countries, because some investors might know where are the production facilities, whether they have been historically impacted by specific events, but some other investors have no clue about it. And I make a simple example. If I live in the Netherlands, I might know a lot about floods, or I might know a lot about storms, but I have no clue about where wildfires happen in Italy every season. But if I am an Italian investor or an Italian in general, I know where wildfires occur all the time. So that's maybe one question and one part of the answer. And the second part of the answer is related to address whether these are global factors or local factors. This is definitely local factor in the specific, given the explanation that I gave before. And there is also literature with publication also in the Journal of Financial Economics showing that local factors are relevant in asset pricing and in the pricing of assets. So I hope this answers your question.
The opposition will be continued by Christy Janssen, who is Assistant Professor of Finance at USC Marshall and DNB. The floor is yours.
So, dear Flavio, first of all, congratulations with a great thesis. I know how hard it can be to work with some of these data sets as I've done it myself, so very well done in that regard. Now, let me just jump right into my question as we don't have that much time left. So my question is also on chapter 2. So local investors are better able to assess the effect of storm risk in price discovery. And my question is a little bit broader in terms of like how AI is going to impact that going forward. So what do I have in mind? So to what extent is the local advantage, for instance, driven by facilities exposure to these type of storms that you could easily detect with AI if you would feed AI like satellite pictures versus perhaps more soft information like how management deals with a crisis that's perhaps not as easy to uncover with AI. So I'm very curious what your thoughts are on that.
Esteemed opponent, thank you very much for your question and also for your kind words. Indeed, working with some of these data sets can be challenging. I do think that your question is very relevant and also very interesting. There are new developments in AI that make, as you mentioned, possible to analyze the exposure and vulnerability of facilities using satellite images. That could be helpful to detect whether the company has been renewing the buildings, if they've been working on adaptation measures. This is something that is visible from outside. But there is a lot of information that is not visible from outside, and this is also not disclosed to the public. Whether then investors can meet with entrepreneurs in local environments, they would have access to this type of information. So I do think that AI, in that specific, will not be able to cover that component. Will definitely allow to have deeper knowledge, and also on the exposure of the companies to the events, but will not be able to cover completely the soft information, in my view. And there is also some recent publication that show exactly this type of results, the relevance of proximity to the source of information.
Perhaps, I mean, I know you have a short sample period, but at least you would expect to find that maybe the effect of local investors like diminishes over time?
Yeah, yes, of course.
Is that something that you've already found?
It could be that over time this effect would diminish, but not yet, as developments in AI on the analysis of satellite images is not as far or widely used by investors at this stage.
Thank you.
So this concludes the first round of questioning. It means we have still time to initiate a second round, and I would like to invite Professor Andronov to ask a second question.
So Flavio, I will continue with chapter 2. It seems we are converging on that one. Niels focused on the headquarters of the firms and Esther on the type of local information, but I will dive a bit more in the ownership measure. So I think you define local ownership as 1 minus, and then the ratio, share of foreign institutional ownership divided with share of total institutional ownership. I have two concerns about this measure. One is, I think firms in general with very low degree of institutional ownership, but few domestic investors, they can end up with a very high local ownership measure. So think about Volvo, owned majority by a Chinese company, few shares are floating around, 2 domestic investors in Sweden bought them, high measure. The second one is, what I also see is that the local ownership measure displays very large variation within Europe. I mean, I thought we are just buying each other's stocks, and all of us here sitting on the panel through our pension funds, including you probably own some Swedish stocks, but apparently not. Sweden, UK, and Finland have a local institutional ownership measure of close to 90%, and many other countries are in the same range. This is despite the growing evidence of, let's say, international diversification that is increasing over time among American, European, and Asian investors. US mutual funds are going around and shopping, and they own, I think, 10% on average of every European company. And the Norwegian Sovereign Wealth Fund, the last time I checked, it owns 2.5% of every European company. So can you reconcile these ownership statistics that are from other data sets on mutual funds, on large sovereign wealth funds with your measure? Like, how precise is your measure, and what is the quality of ownership that we pick up?
Hi, Timo Tonen. Thank you for your question. So the first one, I do agree about your concerns, and most likely applying some sort of weighting in this case would, and showing the results are consistent to a different measure, as I was explaining before, could solve some of the concerns. So applying different type of weightings in the specific. On the other one, on the descriptive statistic on the local ownership across countries in Europe, one has to think about the fact that the sample covered year is the one that is also available in terms of production facilities. So not all information on production facilities is disclosed.
Briefly finish your question. Answer.
So I do think that some of the differences in the statistics you mentioned to the historical development are due to the sample used in terms of facility provided by the European Commission. So, however, I do compare the results also with other former publications, and I find similar results in terms of descriptives.
Thank you, Flavio. Flavio De Carolis, the time appointed for defending your thesis has passed. The degree committee will now withdraw to discuss the quality of your thesis and your defense. I request that you and your company await the results of our deliberations and our return in this room. Flavio De Carolis. The degree committee here present has assessed the quality of your thesis and your defense. In view of its positive verdict and taking into account your previous qualifications, the degree committee has decided to grant you the degree of doctor. Professor Bauer is authorized to confer upon you this academic distinction in accordance with Dutch university custom. I invite your supervisor to take now the floor.
So, Flavio, first a promise, as you probably know. Do you, Flavio, promise to work in accordance with the principles of scientific integrity at all times, to be careful, honest, transparent, independent, and responsible?
Yes, I promise.
Then, by the authority vested in us by law and in conformity with the decision of the committee here present, I hereby confer upon you, Flavio De Carolis, the degree of doctor, and grant you all rights attached by custom and law. As evidence of this, I now present you with the degree certificate signed by the rector, the secretary, and the other members of the committee, and affixed with the official seal of the university, Dottore De Carolis.
Flavio, what a beautiful moment in your life. Congratulations, this is really a truly amazing achievement, I can only say. And we first virtually met at the ECB when you were writing a note. We don't write papers at the ECB with notes, on the Greenium. And already then it was clear that you had not only a sharp mind, but also a strong curiosity for climate considerations and how this interacts with financial markets. And I know, because I am at the ECB, many colleagues at the ECB want to do a PhD, and you made it. Very good. So, still, going back in time, Rob and I, we had an advertisement for a PhD position, and I was really surprised to receive your letter. I didn't see that one coming, but we had a few interviews, and Rob and I were convinced that you were the right person for this job. Now, the curious thing is that the position itself was on climate change and strategic asset allocation. I'm not sure if that word actually occurs in this thesis, because it took a different term. Indeed, what followed was very different and even better, I would say. You produced 3 excellent empirical studies, supported also by theoretical considerations. And that is not an easy task, especially the amount of work, data work behind all of this. So you're very modest in this. We always had to encourage you, please write down that there's a lot of work behind combining all the different data sources. And because that's really impressive. And anyone in this room who ever worked with climate data and financial markets should be familiar with that. So again, well done. And this doesn't end here, Flavio. You are an academic entrepreneur in the best sense of the word. You did not wait for opportunities to come to you. You created them. So you reached out to Nuvolus for computing power, in Switzerland, by the way, to DNB, so the Dutch Central Bank, for access to data, for Banca d'Italia for collaboration, and you were also successful in getting funding from Enquire. So this level of proactivity, dynamism, and also independence is exceptional, particularly during a PhD where you also have to do a lot of research. And yeah, the quality of your work is not unnoticed. So by now you have 2 Best Paper Awards at conferences. Also well deserved, I would say. And obviously you did your fair share of teaching here at Maastricht. You also did a bit of consultancy work along the way. You were a visiting researcher at Banca d'Italia and also in Oxford. By the way, I encourage you all to read his resume in the last part of the thesis. And yeah, you also, sometimes you're surprised that, yeah, I was working on this publication of the Dutch Central Bank on climate change. And yeah, okay. Easy for you. And you also did a lot of summer schools. And then your thesis. So we see the title here, Let's Get Physical. It's spot on. And I think it fits nicely in the tradition that we by now have here in Maastricht of to have prikkelende PhD thesis titles. In the finance department at least. But for those of you who are a bit older, Let's Get Physical is from Olivia Newton-John. I think it was her biggest hit. I don't know, probably in the 80s or maybe even earlier. And I was actually thinking about this last night. I was reading the first part of the lyrics of that song and how your interpretation could be. So I'll first say what she sung, and then I will not sing it, by the way, but I will say it, and then I will say your interpretation. So it starts like this. I'm saying all the things that I know you will like. And then your text would be, I'm stating all the risks that I know the financial markets like. Making good conversation. Your interpretation, careful data integration. I gotta handle you just right. I've handled distance just right. You know what I mean. You know what I mean. I took you to an intimate restaurant. Then your text would be, we went from balance sheets to flood maps. Then to a suggestive movie, and then you would say, then the storm intensity. There's nothing left to talk about. There's nothing left unexplained now. And unless it's horizontally, unless it's geographically. Anyway, Flavio, the title of your thesis is Most Serious. So it's most serious. In expressing the urge of starting to understand only the consequences of climate change in terms of physical risks. We're only at the very beginning of truly understanding the impact of climate change on the financial system. And your thesis is a substantial contribution and also timely contribution to this effort. And I hope you continue working on this. And I must also say, also on behalf of Rob, beyond your academic achievements, you're also simply a pleasure to work with. You are eager to learn. I understand, or I know you travel a lot, and I understand you swim a lot. And lately I hear you talk about horses, and I saw a picture with a dog behind you. What you have done over the last 4 years is truly impressive. And I must also say, Flavio, you're a bit of a puzzle, because sometimes you appear with a beard and sometimes without a beard. And you're both Italian and German. So the question is, are you more German or more Italian? And the answer, I know, I studied this a little bit, is not straightforward. Well, you can read in the thesis that you refer to yourself as a high-maintenance Italian. But at the same time, you also repeatedly use German language and concepts, so such as referring to Rob and I as your doctor father. And this is not symbolic or superficial. It really reflects that you have lived in both cultures. But going a bit deeper, the way you speak, I think, is Italian. Many words. Although you've also had a few moments where you had not so many words today. But in general, you speak with many words, a lot of enthusiasm, and not always immediately to the point. It's like a truly Italian. But when it comes to precision, for instance, in coding, You're unmistakably German, so you have an engineer's mindset. So I would say you're equally Italian and equally German, and probably already a bit Swiss, a Swiss person, which makes you a true European.
Thank you.
Thank you. So you're now in Geneva, and you have a happy personal life, and an exciting future ahead of you. So Flavio, with this you have an outstanding foundation. A PhD from Maastricht sells very well in the world. And yeah, you've grown in your intellectual capacity and your professional nature and also in your personality. So what I would like to say is that we're all very proud of you, and congratulations.
Thank you.
Dear Dr. De Carolis, also on behalf of Maastricht University, I congratulate you with the degree you have acquired. So I would also like to thank the audience for being present today. I would like to invite you already to go to the Refter for the reception. We will stay a couple of minutes behind because we first are going to make a picture with the committee on the stairs. I hereby close this academic session. Thank you.